When analyzing transactions, how do we know what accounts to debit and credit? The thought process to get to debits and credits involves 4 steps. Step 1. What accounts are affected? Step 2. What classifications are those accounts? Step 3. Are the accounts increasing or decreasing? Step 4. Are the accounts debited or credited? We'll practice the thought process by going over a couple of examples. In our first example, assume Braylon is a business owner that goes to the bank to deposit $10,000 in the business's bank account. In the first step, what accounts are affected? By definition, capital, because Braylon is giving money to the business, and cash, because the business's cash went up. In the second step, what classifications are those accounts? Capital is classified as capital, and cash is classified as an asset. In step 3, are the accounts increasing or decreasing? There's a rule that any account classified as capital, dividend, revenue, or expense is normally increasing, so capital is increasing. Cash is also increasing because the business's cash just increased with Braylon's deposit. Lastly, in step 4, use the images provided to get your debits and credits. In this example, both accounts are increasing, so we will use the AED-LRC image. Capital, which is considered capital, is above credit, while cash, which is an asset, is above debit. So capital is credited while cash is debited. This checks out as debits must always equal credits. The first 2 steps takes practice, but for now, let's say we mastered them. Let's skip to steps 3 and 4. Example, purchase supplies on account. The accounts involved are supplies, which is an asset, and accounts payable, which is a liability. Since supplies have been purchased, it is increasing. Use the left image, AED-LRC. Supplies is an asset and is above debit. Supplies is increasing and it is debited. Next, we have accounts payable, what the business owes. It is also increasing, so use AED-LRC. AP is a liability and is above credit. So accounts payable is increasing and is credited. Let's continue with another example. Paid office rent. The accounts involved are cash, which is classified as an asset, and rent expense, which is classified as an expense. Cash is decreasing since the rent was paid, so use the LRC AED image. Cash is an asset which is above credit. Thus, cash is decreasing with a credit. Rent expense is increasing. There's a rule that any account classified as an expense is always increasing. Use the AED LRC image. Expense is above debit. Rent expense is increasing and is debited. Let's go to our next example. Provided services to a customer on account. The 2 accounts affected are fees earned, which is a revenue, and accounts receivable, which is an asset. Fees earned is increasing because revenue accounts are normally increasing. Use the AED-LRC image. Revenue is above credit. Fees earned is increasing and is credited. Accounts receivable, what the business expects to receive from the customer in the future, is also increasing. Use the AED-LRC image. Asset is above debit. Accounts receivable is increasing and is debited. A business purchased a computer for cash. The 2 accounts involved are computer, which is an asset, and cash, which is also an asset. Computer is increasing, so use the AED-LRC image. It is considered an asset and is above debit. Computer is increasing and is debited. Cash is decreasing since the computer was purchased. Thus, use the LRC AED image. Computer is an asset and is above credit. Cash is decreasing and is credited. Our next example involves paying a supplier for an amount owed. The 2 accounts affected are cash, which is an asset, and accounts payable, which is a liability. Cash is decreasing since the supplier was paid. Use the LRC AED image. It's an asset and is above credit. Cash is decreasing and is credited. Accounts payable is also decreasing since the supplier was paid. Use the LRC AED image. Liability is above debit. Accounts payable is decreasing and is debited.